Good afternoon. My name is Thomas Senek. I'm the founding partner of TM Wealth Management, and we're glad you could join us today for our webinar, Alternative Investments. Is Real Estate Back? Today, we're going to cover a number of things, and to be respectful of people's time, we don't have time for questions, but there is an opportunity at the end of the webinar for you to submit questions, and any questions we get, we will respond back to you as well. Another thing, you can also indicate at the end in the survey, once you complete the survey, if you'd like copies of these slides, we can give these copies to you as well so that you have these for your information. Quick disclosure, this is not designed to be legal, tax, or even financial advice. This is educational in nature. If you have specific questions, you're really like to get some financial advice, please reach out to us, get some time scheduled. We're happy to talk about things over the phone, get your questions answered with no cost or obligation. Really do just want to provide some education so that you can make good financial decisions. Just a little bit of background on me. I started my career on Wall Street, working for Goldman Sachs and Deutsche Bank. I really enjoyed working on Wall Street, but I learned two important things about investment banking is that one, it was not conducive to a family. And that was something that was important to me. And then two, I also learned that it was very transactional. We would do an IPO or an M&A transaction, and we'd complete the deal, and the very next day we're back looking for another transaction. And for me, that wasn't very fulfilling. I didn't feel like I was doing something that had a significant impact. So I transitioned from investment banking to wealth management, and now I have the opportunity to sit across families and individuals and help them make good decisions with their money so that their resources have the impact on people and causes they care about most. And I find that very rewarding and very fulfilling. And then just a short commercial about our firm. On Wall Street, I also learned how I'd like to structure things. And the first thing that was important to me is that we are independent. We don't have a home office. We don't structure the products. We're not out there trying to promote a product. We're independent. We work specifically for and with our clients to make sure that they have the advice that they need to make good financial decisions. Secondly, it was important to me to be boutique, right? Goldman Sachs and Deutsche Bank, these are large, what are referred to as bulge bracket investment banks. And in that organization, it's hard to add value to thousands of client relationships. So for us, boutique for us means that we allow ourselves to go deep with each individual client so we know everything about their financial picture, whether it's finance, estate planning, tax planning, insurances. We know everything and can give them comprehensive advice on everything that's happening in their lives. Then the third thing was wealth management. This idea that we don't just look at your stocks and bonds or your investment portfolio. We want to be involved in everything that's going on, kind of function as your financial quarterback so we know what's going on in all aspects of your financial lives. And then lastly, the way in which we are structured legally, or the regulatory environment in which we operate, is as an SEC registered investment advisor. What this means is we function under the fiduciary standard, which means we have a legal obligation to do what's in the best interest of our clients. And that's important. Not everyone out there giving financial advice is registered under that standard. So we think it's important, an important indicator of how you want to interact with your clients is how you are registered to provide that financial advice. And for us, that SEC RIA registration is important. So let's get into our topic, alternative investments. I think what's first important is that we talk about what are alternatives. And when we look at the entire investment universe, a lot of us just think, hey, it's just stocks and bonds, right? I can buy equities or I can buy fixed income. And that's the investment universe that most people have available to them and are aware of. And that's kind of like if you're doing a construction project, all you've got is a hammer. What we want to do with alternatives is expand the investment universe and your understanding and knowledge of all of these areas of investment. So in addition to stocks and bonds, we now have real estate, private equity and venture capital, hedge funds and liquid alternatives, and commodities and managed futures. And it's kind of like having an entire toolbox to help build your project. And so what we want to do is expand that investment universe so that you are aware of some of these other alternative types of non-traditional investments that can help you achieve your financial goals. But why? What's wrong with stocks and bonds? Well, nothing. They're great assets and provide a lot of liquidity, but there are other areas of investment where you can get additional return. And one of the key reasons that we look at alternatives for our clients these days is because if you look at the long-term forecast for certain asset classes, and this is a forecast that Morningstar does every year, and this is their 2024 forecast, and they get out there and talk to a number of these investment houses, BlackRock, JP Morgan, Morningstar, research affiliates, Schwab, and Vanguard, and say, what do you think the long-term asset class return is going to be? And if we focus over here on this area of US equities, you can see here with JP Morgan as the outlier, it's 7% annualized returns over the next 10 plus years. And then you've got, here's research affiliates, and in some cases, Vanguard, right? They think the long-term average is going to be somewhere between 4 and 6%. So what we look at it, and in the financial plans that we develop, a 4% annualized return, especially when you've got inflation right now at about 3 to 3.5%, the real return to our clients is very low. So we now need to start looking at other areas that can bring some additional return to the overall portfolio outside of stocks and bonds. All right, and you look over here on the bond side of things, it's very similar, right? Again, Morningstar is about 4%. You've got research affiliates at 4.8% for bonds. JP Morgan, 5.8%. You've got BlackRock at 5%. So these lower investment returns over the long term cause us to think about how can we go and get more return given these lower returns in our traditional assets of stocks and bonds. The challenge with that is we can always go and chase return or chase yield, but what kind of risk does that bring into it? And that's an important element to understand with alternative assets, because they have the ability to not only increase the potential returns of a portfolio, but also reduce risk. Sounds too good to be true, right? Increased return, lower risk. Let's take a quick look at how this works. So this is what's referred to as the efficient frontier, right? It looks at what is the risk, expected volatility here on the lower axis, and then expected return. So what return are we going to get for what level of volatility or what level of risk, right? So you can see here for this level of risk, we would expect to get this level of return. And there's a graph that shows us every level of risk and what the potential return is. And these are traditional investments. So you can see here, the more risk you take, the higher the potential return. What alternatives do is they cause this risk return graph to shift upward, right? So same graph, but now we have traditional and alternative investments. So for the same level of risk, we now have a higher potential return, or we get lower risk with the same level of return. So alternative investments shift the risk return curve that helps us potentially get higher returns for the same level of risk or the same returns for lower risk. And it's not an insignificant allocation to alternatives. Usually to get this risk return benefit from alternatives, you need to have somewhere between 5 to 20% of your overall portfolio in these types of alternative assets. And we'll talk a little bit more about that. This graphic here also goes into more detail about that same curve, right? So if we took the previous graphic here with this risk return curve, we can see the same thing happening here with these lower pie charts, right? Same risk return graphic, right? Here's the risk return, risk of volatility of 7%, potential return about 7.5-ish, 7.3. That's the risk return profile of a 60-40 portfolio. If we now add alternatives to that portfolio, so we add 30% of alternatives, now the risk return, the risk goes lower. So now we've got about a 6.5% volatility, and we've got an 8% potential return. And this goes all the way down the line. You can see over here in this box here where it indicates those risk return dynamics, right? So the 60-40 portfolio we just looked at, 60% equities, 40% bonds, has a volatility of about 9.6 right here. You can see here 9.6, and the annualized return for that is about 8.3. By shifting and adding alternatives to that portfolio, we now have a risk return profile where we've got 40% equities, 30% bonds, 30% alternatives. The volatility or risk metrics goes down to 7.9, almost 8, and the return goes to 8.9, right up here, almost 9%. So the real key to alternatives, one of the key benefits, is it reduces risk and increases potential returns. So that's one of the key reasons. One, it diversifies your portfolio, but it does it in a manner in which it reduces that risk and increases potential return. So when we talk about alternatives, let's look at some specifics, right? These non-traditional or alternative assets. These are like things like private equity. So this is investing in companies that do not currently trade on the public markets. You can't go on your Schwab platform and buy interest or shares in these private equity companies or these private companies. You know, things like it gives an example there of Burger King, right? Venture capital. This is similar to private equity, but private equity usually invests in established companies. They've already started generating revenues. They've got earnings, net income. They're growing, but they are established. The risk of them going out of business has been reduced. Venture capital is dealing with early stage growth companies that may or may not make it, right? So the usual venture capitalists think, well, if I do 10 investments, 9 of them will probably fail, but one of them will be so spectacular that it will pay for the 9 failures and give me a great rate of return. So higher risk, but higher potential return. Private debt, much like private equity, this is loaning money to companies that are private as well. And then hedge funds are investment vehicles that invest money in anything they think will provide a return, right? They can be shorting stocks, they can use options, they can go into private equity, they can go into real estate. Really what it is a somewhat of an unregulated type of investment strategy. And then lastly, real estate funds, right? You can be real estate investment trusts, direct investment in real estate. These are illiquid type of assets that you're investing in, both alternatives, but specifically in real estate, going out and getting into real estate that might have stable cash flows. It might not have any cash flows. It might be a development project. You can invest in just pure land. And so one of the key considerations when you think about alternative investments is to understand the dynamics of these specific investments. We're all very comfortable with, you know, our Schwab logins, and we can go in and buy and sell stocks and bonds second to second, and we get our cash now the very next day, right? So that's a very liquid product. But in some cases, you're paying a liquidity premium, or you're paying an additional cost for having that ease of access to turn that investment into cash. By investing in alternatives, these are illiquid vehicles, some of them more than others, that now you can't just log into your Schwab platform and sell the interest from one day to the next. It might take maybe once a quarter, maybe it's once a year, maybe it's every 5 years. Maybe it's only when there's a liquidity event, meaning they sell some real estate and then they're going to distribute it. So that can be 10 plus years that you are in this investment before it is going to provide you your money back or the investment returns. And those are some of the key considerations as you think about the alternative investments. One of the other key considerations when you think about alternatives is if you're going to buy into an alternative type of fund, manager selection is essential, right? So if we look at this, these are all some of the different types of alternative managers, right? So global equities, global bonds, core real estate, non-core real estate, global private equity, global venture capital, hedge funds. So let's kind of take a look at and explain how this graph works, right? Take global private equity. What this says is returns over a 10-year window have ranged anywhere between up 24% and up 3.8%. So this 24.3% is by the top quartile of all investment managers in global private equity. The 3.8% is the bottom quartile. The average return within that alternative fund structure within global private equity is this orange diamond, so about 15%. So what that shows you is if you happen to select a bottom quartile manager, you got 3.8%, and you missed out on an additional 20+% just because the manager wasn't in the top quartile of the managers. So as you look at this, right, within these last four categories, it really is significant when you're talking about non-core US real estate or venture capital or hedge funds or global private equity. The manager really matters. When you start to get into, US fund, kind of global equities or core real estate, it doesn't have quite as wide of a dispersion in terms of the returns. But you always want to be aware of what is the manager's track record, what have they done historically, what's their background, how have they demonstrated that they are better at this than some of the other managers. So now that we understand kind of why alternatives, and now we understand what alternatives are, let's talk briefly about, or not briefly, let's dig into the real estate element of alternatives, and is it back? And let's look at a couple of graphs. We'll talk globally, and then we'll talk very locally in our area here in the Northern Virginia area as well. So sources of global real estate returns. What this is illustrating for you is where are the returns coming from? Is it capital appreciation or is it income? And if you look on this graphic, right, the dark gray bars, this is how much of your real estate return is coming from income. And then the blue bar, or sorry, yes, coming from income. And then the blue bar is how much of that is capital appreciation. And what you see over time, the bulk of global real estate returns comes from the income, right? Somebody's leasing this out and paying rents on the property. So it's generating some income for you. And as we fast forward to the last couple of years, you can see that that dynamic is changing, right? No longer are we getting as much capital appreciation because of the interest rate environment that we're in. And income becomes a much more important element of how you're going to get your real estate returns. So you start to look at these opportunities, you need to understand, am I investing in something for the income? Am I investing in it for the capital appreciation, meaning it's going to increase in value over time? Or is it a mix between the two? And understanding the dynamics between those two elements to make sure you're comfortable with that return, right? If you're getting into something like, undeveloped land, you're depending on the capital appreciation because now there's no income coming in, and that's a longer time horizon. If you're buying an already income producing property, then that is something where you can start to get your returns very quickly and also get some liquidity faster because you have income from this property based on the rents that it's able to get. And then this next graphic is indicative of alternatives versus traditional investments, right? So this looks at U.S. real estate investment trusts, right, or this gray bar, and direct real estate investments, and how these move in relation to the S&P 500, right? And so the S&P 500 is very liquid, right? We can go in and buy and sell securities that track the S&P 500 minute by minute, second by second, day by day, right? Direct real estate, not quite so much. And you can see that the direct real estate actually has what's called a negative correlation to the S&P 500. What that means is that it moves independent of the broader market, whereas real estate investment trusts, which are normally liquid, elements that you can buy on the US stock exchange, they have a correlation, at least recently, pretty close to 1, meaning it moves almost identically to how the market moves. And that kind of makes sense, right? Because, it's kind of this idea that water lifts all boats, right? So as the market goes up, it brings these quasi-alternative investment type strategies of real estate investment trust with it. And when you're dealing with alternatives, we really want to focus on this correlation. One of the key elements, if we come back to our efficient frontier graphic, one of the key elements that we want is we want our alternative investments to move independently of our traditional assets. We want something to zig when other things are zagging, right? When something's up, we like something else, not necessarily like it, but it may be down. And when something's down, we want other things to be up, right? So that's one of the key benefits as we look at alternatives and specifically real estate in our portfolio. So this is really kind of an argument for if you're going to do real estate and have the financial resources, it may make sense to do real estate in a direct fashion rather through a real estate investment trust because of this non-correlated benefit, right? If everything in your portfolio moves together, that's great when the markets are moving up. When the markets are moving down, it's not great that everything's moving down together. We want something that is going to move independent of where the broader market, and that can sometimes be real estate. Then as we look on a global basis or on a US basis, right, what types of real estate are performing well? So on this left-hand graphic, you can see US vacancy rates by property type: apartment, industrial, office, and retail. And if you are owning real estate, especially income producing real estate, which if we look back at this graphic, right, income has been pretty stable over time. So it's nice to have some stable income producing real estate. You need renters or people in there leasing the properties. And so we want the vacancy rate to be low. And we can see, office space, the vacancy rates are increasing. And that's a direct result of COVID, right? And most people are able to work from home or come into the office only occasionally. So vacancy rates for office are increasing. Retail has been increasing, but not nearly as much as office space. Apartments have been pretty consistent over time, right? There's some ups and downs, but usually vacancy rates there between 6 and 8%. Industrial has been an outperformer in terms of vacancy rates, right? You can see down here we're in the 2% range, whereas back in 2010 it was in this 12% range. And if you think about that, the challenge with industrial is most municipalities do not want some sort of industrial, tow yards or storage areas or auto body shops. Those are types of industrial properties. They don't want those within their municipalities, within their communities, because they usually don't look great. They create a lot of mess and aren't necessarily clean in terms of what the municipalities may want to look at. So the inventory for retail throughout the country has been reducing, but the demand is increasing. And so industrial property is kind of the outlier outperformer within real estate generally. And then this other graphic gives you the net operating income growth by property type. So how much of your net income, net operating income, this is after your expenses, your revenue minus your expenses, gives you an idea of how well these are producing distributable income, right? You can see here again, industrial is outperforming the remainder, where everything else is kind of on a downward trend. Not to say that there aren't opportunities in office and apartment and retail, but on a national basis, those types of properties are challenging. And as we all know, within real estate, it's all about location, location, location. So there are pockets where this might make some sense, but again, you want to do your due diligence to understand what are the different dynamics that might make this specific property outperform the national averages. So now let's get into some more specific areas. And this is just looking at the residential outlook for both Fairfax County and Loudoun County, which are two of the more larger counties in Northern Virginia, but also some of the more affluent, where there's a tremendous amount of buying and selling of properties, of residential properties. And what this looks at within Fairfax County, the median single family sales price, right? And so bottom left, it's got a great trend up to the right, showing that prices are increasing. Now they've somewhat plateaued, and they're expecting to increase by about 5% for this year. But you can still see, even in a challenging real or interest rate environment, still expecting that the median single family sales price will increase in Fairfax County by about 3.5%. And then the challenge, and this is all across the country, and specifically here in Fairfax County and Loudoun County, is the amount of inventory. So this is the amount of sales, right? We've seen it, spike at different times. It's very seasonal, but we see it declining because the sales forecasts are lower because of the inventory, right? There's an interest rate environment that is causing more people to stay in their homes rather than putting them on the market. Builders aren't building quite as fast or as many as they used to because of this interest rate environment that aren't as many buyers. So we have a supply demand issue going on across the country, and here specifically in Fairfax County and Loudoun County. And this also gives you the same indication that the amount of inventory in the Fairfax County single family inventory is significantly lower. It's historically lower. I think the difference between last year and this year, we have 20% less units for sale than we had the previous year. So that dynamic is causing this idea here of the increase in single family sales price, because when there's fewer inventory, but still buyers out there want to buy it, that causes the pricing to go up. And now let's look at Loudoun County, right? So same thing in Loudoun County, the median sales price is going to be up about almost 6% this year in Loudoun County, up to over $1 million in the median sales price in Loudoun County. And then the single family sales, again, it's seasonal or cyclical, but also declining. And it's that same inventory issue that we're seeing in Fairfax County, same issue here in Loudoun County. So we've got less inventory because of this interest rate environment and some of the uncertainty that's going on in the economy. What's going to happen with my job? Is my company still hiring? People are getting a little more protective of their resources and aren't willing to go out and take on a 7 or 8% mortgage to be able to get into one of these expensive homes. So we've talked about a lot in terms of alternatives, the benefits of alternative. We talked specifically about real estate. And again, when you think about whether or not it makes sense to add real estate to your portfolio, it is very location based. And so you want to make sure you're doing the due diligence to understand what is unique about this property, and is it going to help me accomplish my financial goals, right? Am I adding real estate just to add real estate because I think I should have some? Or are you being strategic about it and say, well, I'd like to have some income producing real estate because I'm looking to retire soon, and I'd like to have some more things within my portfolio that are generating cash flow distributions to me that I can live on? Is it that, hey, I see opportunities in a specific area for growth, and I want to participate in the appreciation that's going to happen in that particular area? And really looking at, does it make sense to go direct and buy a building yourself, or to get into these funds that buy buildings direct for a number of investors? And in most cases, that's what works best for people. One thing to be aware of, most alternatives and alternative strategies have a requirement that you be an accredited investor to be able to participate in some of these funds. And that accredited investor statistic is have a net worth of over $1 million or have made over $400,000 over the last couple of years on your tax returns. And so, being able to qualify for some of these investments is also sometimes challenging. So looking for, how can I get access to these types of strategies in a way that fits with my goals and my overall portfolio? And that's kind of our role. As we sit down with our clients, we have access to both direct investments and also fund type investments, and say, okay, what are we trying to achieve here? Is it lower risk? Is it more income? Is it potentially higher returns? Does it make sense to have, diversify between private equity, real estate, and some of the other alternative type strategies? And how do we now go through our due diligence process to make sure we select the correct manager? So we've gone through a lot of this. You may be thinking, okay, great, that's interesting. So now what do I do? I understand what alternatives are. I understand how they operate and why I may want to add them to my portfolio. Kind of understand the real estate dynamics going on. How do I now start to apply some of this information to my unique situation? And the first thing you want to do is kind of understand the pros and cons between alternative investments. right? So the pros are it's a counterweight to conventional assets, traditional stocks and bonds. It provides portfolio diversification. It can sometimes provide an inflation hedge, right? As inflation continues to go up, some of these assets like real estate and commodities can increase as inflation increases. And it also gives you the potential for higher returns. Some of the downsides or cons are they're difficult to value. Even when you own real estate, you may get an appraisal, but at the end of the day, the asset is only worth what somebody's willing to pay for. And so they're difficult to value. The illiquidity, that's an important element, right? As we talked before, having somewhere between 10 to 20 and sometimes 30% of your portfolio in alternatives may not work because you need the liquidity. You need to be able to spend these resources. There's fewer regulatory requirements, and they can potentially be higher risk type of vehicles, depending on your overall portfolio structure. The other thing to understand is what's the risk spectrum for the different types of alternatives, right? So both the less beta or moves less like the broader market, real estate, private equity, those types of things have less correlation with the broader market or less beta, and potentially less risk. But as you move up to hedge funds, real estate, private credit, and then you move over to hedge funds and private equity and venture capital, those have higher growth, but also bring in some higher risk as well. And so you want to understand that risk return dynamic so that you are making the best decision for you, and you know how these investments are going to help you accomplish your financial goals. The last thing you can do is reach out to us for resources, right? We've got a guide for understanding alternative investments. If you'd like a copy of that, you can fill that out on your survey at the end of the webinar. And we're happy to share that with you both electronically or in print format. We have other resources, right? Estate planning is an important element of a comprehensive financial plan. And going through a beneficiary audit, right? If something happens to you, who's going to get all your assets, right? Have you gone through and made sure you'd update your beneficiaries on your 401k or IRAs? And those are some key elements. And we've got a number of resources in terms of helping you make good financial decisions, but also in educating you on these different topics. And the last thing I would recommend is reach out to us. We have a process that we call our financial roadmap. It's free. We don't charge anything for it. We don't have any obligation that you join or have an ongoing relationship with us. But it really is an opportunity for us to sit down with you and your significant other and understand what's important about money to you. Get some milestones in terms of what are your financial goals and what are the timelines associated with them. Take a look at what you've currently got going on and how you can optimize what you have to accomplish the goals that you have and the timelines that you've identified. And that's what we call our financial roadmap experience. We can do that in person and virtually as well. So a plethora of resources for you to decide what is going to be the next best step for you so that you can make better financial decisions. And we hope that this webinar about alternative investments has provided you with some education to better understand the investment universe out there so that you can evaluate your current investment portfolio and see if some of these potential alternative strategies might work best for you.